What is amortization, and what is a 1031 exchange? If your browser history features these words, you're in the right place. Amortization and 1031 exchanges are some popular words in the real estate industry and might get a little confusing, especially if you're new in the field. But worry not, because we've got your back. In this video, we explain these concepts in real estate to help you understand and apply them in your practice. So sit back, relax, and enjoy the video. Let's start by defining amortization. What is amortization? Amortization is a method of paying off debt in equal installments that include varying amounts of interest and principal payments over the life of the loan. In real estate, amortization is a mathematical process that dictates how much of a homeowner's monthly mortgage payment goes towards the interest and principal of the loan. The amortization process generally operates along a curve rather than a straight line, especially in fixed-rate loans. Let's go over a few key terms. Fully amortized loans. A fully amortized payment is one where if you make every payment according to the original schedule on your term loan, your loan will be fully paid off by the end of the term. Positive amortization. Lenders generally require borrowers to repay part of the principal with each loan payment to minimize their repayment risk. This reduces the loan balance with each payment. This is called positive amortization. Negative amortization. Negative amortization is when a borrower makes the required payments on a loan. Still, the amount they owe continues to rise because the minimum payment doesn't cover the interest cost. But how does amortization work in real estate? In real estate, amortization can be in the form of fixed-rate mortgages, adjustable-rate mortgages, ARMs, interest-only mortgages, and balloon mortgages. Fixed-rate mortgages. A fixed-rate mortgage is an excellent option if you want to stay in your home for a while. These types of loans have a fixed interest rate throughout the loan duration. The amount a borrower pays may fluctuate based on local tax and insurance rates, but fixed-rate mortgages provide a predictable monthly payment for budgeting purposes. At the beginning of a fixed-rate mortgage, more of the monthly payment covers the interest. Over time, that changes, and more of the monthly payment is applied to the principal as the interest balance decreases. Adjustable-rate mortgages, ARMs. Most adjustable-rate mortgages, ARMs, have an introductory period between 5 and 7 years where the borrower pays a fixed interest rate that is usually lower than the market rate. Once the initial period is over, the lender will then look at a predetermined index to determine the appropriate rate for the borrower. If the market interest rates have increased, the borrower may see an increase. If the market rates have decreased, the borrower could see a decrease in their interest rate. ARMs have a cap for the highest and lowest interest rate your loan can incur. Interest-only mortgage. Interest-only mortgages can be an appealing loan type if you want to buy a home and keep the monthly payments low. With a 30-year interest-only plan, the borrower may only pay interest during the first introductory 10 years, and after that, principal and interest payments are made for the remaining 20 years of the loan term. Balloon mortgages. A balloon mortgage is any financing that features a lump sum payment schedule at any point in the term. Balloon loans can be structured in several ways. They can be interest-only payments during the introductory period. Many balloon mortgages include principal and interest in monthly payments. Still, the borrower must always be ready to deal with the lump sum payment, usually at the end of the loan term. And what is an amortization schedule? Understanding amortization in real estate modeling requires the help of an amortization schedule. An amortization schedule is a table that breaks down the payments scheduled over a loan's lifetime. There's also a detailed account of the amount of principal and interest to be paid each month in the amortization schedule. Amortization schedules are essential for understanding the lifespan of your loan and its effects on your financial future. Now that you know the basics of amortization, let's discuss 1031 exchanges. What is a 1031 exchange? If you own investment property and are thinking about selling it and purchasing another property, you should know about the 1031 tax-deferred exchange. A 1031 exchange gets its name from the Section 1031 of the U.S. Internal Revenue Code, which allows you to avoid paying capital gains tax when you sell an investment property and reinvest the proceeds from the sale within certain time limits in a property or properties of like kind and equal or greater value. Why opt for a 1031 exchange? As a real estate investor, there are several reasons why you may consider utilizing a 1031 exchange. Some of those reasons include: you may be looking for a property with better return prospects or wish to diversify assets. If you are the owner of investment real estate, you might be looking for a managed property rather than managing one yourself. You might want to consolidate several properties into one for purposes of estate planning, for example. Or you might want to divide a single property into several assets. Reset the depreciation clock, which we'll explain in a few minutes. The tax deferral is the main benefit of carrying out a 1031 exchange instead of selling one property and buying another. A 1031 exchange allows you to defer capital gains tax, thus freeing more capital for investment in the replacement property. It's essential to remember that a 1031 exchange may require a comparatively high minimum investment and holding time. This makes these transactions more ideal for individuals with higher net worth. 1031 exchange transactions should be handled by professionals due to their complexity. Choosing a replacement property. Like-kind property is defined according to its characteristics rather than its quality or grade, meaning there's a wide range of exchangeable real properties. Vacant land can be exchanged for a commercial building, for example, or industrial property can be exchanged for residential. But you can't exchange real estate for artwork, for example, because that doesn't meet the definition of like-kind. However, the property must be held for investment, not resale or personal use. This often implies a minimum of 2 years ownership. Your replacement property should be of equal or greater value to receive the full benefit of a 1031 exchange. You must identify a replacement property for the assets sold within 45 days and then conclude the exchange within 180 days. 3 rules can be applied to defined identification. You need to meet one of the following. The 3-property rule allows you to identify 3 properties as potential purchases regardless of their market value. The 200% rule allows you to identify unlimited replacement properties as long as their cumulative value doesn't exceed 200% of the value of the property sold. The 95% rule allows you to identify as many properties as you like as long as you require properties valued at 95% their total or more. Timing the exchanges. The IRS allows 1031 exchanges to be formulated in 4 ways: simultaneous, delayed, reverse, and construction improvement. Simultaneous exchange. With the simultaneous exchange, you're simply buying and selling real estate as close to the same time as possible, or swapping the property you're selling for the one you are buying. But since any delay can jeopardize the exchange, and if the trade fails, you can say goodbye to the tax advantages. Delayed exchange. Delayed exchanges are the most popular type and are sometimes referred to as Starker exchanges after the decision in Starker versus United States. The court ruled that a property owner can sell their property, transfer any proceeds from the sale to a qualified intermediary who must be a neutral party with no connection to either buyer or seller, and then have that intermediary purchase the new property. For a delayed exchange, you'll need to do the following. Identify the property you wish to buy within 45 days of the sale of the original property. Close on the property within 180 days. Purchase a property that is of like kind to the one you sold. Taxpayers must file Form 8824 and their tax return to report the 1031 exchange. Reverse exchange. In this exchange, an investor buys the property they're interested in before selling the property they currently own. These exchanges generally abide by the same rules as delayed exchanges in reverse. Investors have 45 days to identify the property to be sold and 180 days to complete the sale of that property. These tend to be all-cash deals, as banks generally will not issue loans for reverse exchanges. Construction or improvement exchange. Suppose the investor trades their buildings for vacant or underdeveloped land. In that case, they can use the proceeds from the sale of their property, transfer it to a qualified intermediary, and have that intermediary pay for construction to improve the property. To qualify, the following is required. The entire exchange equity must be built by the 180th day after the sale. The investor must receive substantially the same property that the investor reported to the IRS on the 45th day. When deeded back to the taxpayer, it must be of like kind. 1031 exchange tax implications, cash and debt. You may have money left over after the intermediary acquires the replacement property. If so, the intermediary will pay it to you after 180 days. That cash, known as boot, will be taxed as partial sales proceeds from the sales of your property, generally as a capital gain. One of the main ways people experience trouble with these transactions is by failing to account for loans. You must consider mortgage loans or other debt on the property you relinquish and any debt on the replacement property. If you don't receive cash back, but your liability goes down, it will also be treated as income, just like cash. What about depreciation recapture? A 1031 exchange means you avoid capital gains taxes, but you may owe income taxes in some instances. Suppose you own the property for some time. In that case, you may have taken depreciation deductions that reduce the property's net adjusted basis, which is the original purchase price plus capital improvements minus depreciation. If you sell it for a price higher than the net adjusted basis, the depreciation is recaptured, meaning that the profit above the net adjusted basis is taxable as income. Moreover, any money left from the sale of the first property after purchasing the second property is also taxable as income. This is why it's essential to ensure that the property you want to buy is of equal or greater value. And that explains amortization and 1031 exchange. We hope you enjoyed this video and be sure to subscribe to our channel for more of our awesome content. And please give us a like, share the video, and don't forget to turn on the notification bell for timely updates of our new uploads. We value your feedback, so feel free to share your thoughts with us in the comments section down below. See you in the next video. Goodbye.